Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, "The ultimate in real estate is being the bank." And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Everybody. So you guys all know the story. You've heard this before, most likely. How many of you, this is your first time being here? How many of you guys never heard what the money multiplier method was? This is your first time being on a webinar with us. You don't even know what I'm going to talk about. How many of you guys, this is your first time? Vince done some background, first time. Yeah, a couple others. You know, this is something that I hold very tight to my, what I teach and what I want others to understand about money. And so we're going to talk about very old strategies, talk about some very new ideas, talk about real estate, talk about debt payoffs, talk about more efficient ways to spend our money. You know, we've all spent most of our adult lives paying the banks, paying creditors and our expenses. And at the same time we're doing all that, we're watching our retirement accounts, our legacy fluctuate and kind of evaporate in the markets. Things change. We've been taught to take on risk ourselves and give away the control of our money, which makes no sense to me. And the wealthiest people don't do that. People find ways to control everything. They don't let anybody else control their dollars, their retirement, their future, their legacy. And so what we're going to hit on today is a 200-year-old strategy. This presentation is going to go over this old strategy used by the wealthiest families to eliminate debts, minimize taxation, and really leave a legacy behind. And I'm going to show you guys how to do all of that without taking on any more risk, without working any harder, without really changing much of your expenses or anything. This is just going to change where your money goes first. And we're going to find ways to not lose control over our finances. So let's dive right into that. How many of you guys at one point or another in your lifetime felt like you did not have control over your finances, over your financial future? Let's hear it in the chat. Guys, today I want this chat to be very lively. If you're just here listening, not commenting, not being interactive, you're not getting everything out of this that you can. So be interactive. Let me know, emojis you're feeling, dots you have throughout this presentation, questions that pop up. First question being, how many of you not had control over your money at some point in your life? Is that something you guys feel like is been a part of your financial mindset? Not having control, being worried about things? Right? And why are you guys here today? Probably because you want to find more ways to control your finances. So first off, I want to, wherever you're at in your financial journey, you could be very well versed in this. This could be your first time. I congratulate you guys for being here and I welcome you. Why? Why do I say that? Well, because there's so many people out there that just talk. People claim they want to do better. They claim they want to do good, but they're not here. They chose to skip over this presentation. They chose to not learn and take their energy and time into becoming better. And the thing that you guys and I have in common today is that we are here. We are here to be better. We're here to learn. And listen, wealth is a long-term game. So it's only going to it's going to be a lifelong of learning. And so today could be the first step for you. Now, whenever I walk into a room where I'm presenting in person, or if I'm on a webinar like this, I always think to myself, what am I going to get out of this? So if I was sitting in your guys' chairs, I would want to know what you're going to get out of the next hour. And for me, when I present, I like to just start off with that so you're not confused or surprised. This is what we're going to dive into today. These 4 things. First, protection, because who doesn't want to protect the money they make better, right? Second, being tax-free growth. We all have better money moves we can make to eliminate taxes. We're not taking advantage of them. Next, being leverage, because we have opportunities. We have money leaving the door that we're not leveraging better. And last, legacy, because we're not here just to teach ourselves. We're here to leave a legacy. We're here to teach those around us, especially our family members, our kids, our grandkids, our friends, our communities need to be learning about these strategies as well. So that's what I'm imploring in you guys, is to learn these things, take it in, do it, and then share it. Now, I have a system that helped me accomplish all of these things. If you guys today could take home a blueprint from me with all of these 4 things, do you guys think that'd be worth your time today? Yes or no, right? Of course it would be. So I guess just for you guys to have a little bit of a, confidence in your speaker. Those of you who don't know who I am, I think most of you do. But those of you who don't, here's a quick intro. This is my wife and I, Anna Herline. We live in Southern California. But over the past few years, I've built a foundation for our young family to not just be rich, but to build something generational. And I can sum that experience up with 2 words. That'd be gratitude and choices. I'm so grateful that I get to just feel secure and confident in my financial future. Most people can't say that. And I'm grateful for the opportunities that I've been given, because I've had so much opportunity to learn and grow at a young age, where now I want to share this with others. And I say choices because I get to choose every single day what I do. If Anna and I wanted to go to Europe next week and get up and leave, we could. And that's pretty freaking awesome. This control and freedom in our financial life has bled into our personal life, and it's made life fun. And my story is pretty simple. I'm sure most of you actually can relate to it, because in my early years, I made a lot of mistakes, as we all do. We all make mistakes. But when I was 18, I did one thing right. I went and served a church mission and lived abroad for a year, and I served people. It's an amazing experience. But when I came home, I was in college. I had a ton of outside influences pushing me different directions. In one hand, I held the traditional route. I held the mindset of going to school, going down the rat race, and being a part of corporate America. And in this hand, I held and was around business owners, entrepreneurship. I saw the control and freedom they had in their lifestyle. And I had to decide, what route did I want to take? And I had, I guess, a lot of tension pulling these 2 ideas apart. And that decision I had to make. Which direction do I take? And the decision to drop out of school and pursue an education in investing and start making money, learn how to make money work for me, that completely changed the course of my life. But above all, what's most important to me is family. So how many of you guys are here today because you'd like to have enough money to spend as much time as you'd like with your family, right? Don't we all? Well, let's talk about you guys. Let's talk about why you guys are here. Well, you guys are what I call the 5%. You are the 5% because you're here on this webinar. You're taking control over your financial future, and that's pretty freaking awesome. Now, if I was to ask 100 18-year-olds, just like I was, and said, hey, if you had 45 years to grow, you were going to be 65, and you were hoping to be financially secure at retirement age, would you be able to be? Would you be rich or wealthy by the time you were 65? I bet you every single one of those 18-year-olds would say, of course, no doubt in my mind, because they have so much time in front of them. But something happens from when they're 18 until they're 65 that changes the whole dynamic. And the Social Security Administration summed this up perfectly. They said 5 out of 100 people will be financially secure at retirement age. Think about that. In America, the land of opportunity, the land of freedom, people are not able to be secure financially with all the opportunities we have around us. And not, it says 5 out of 100 people will be secure. They don't say rich, not wealthy, not happy, secure, just enough. And that's only 5% of people. So the other 95% of people are working until they're 70, 80, taking on 2 jobs, depending on other people to survive. and not taking control of their lifestyle. And you guys here can be ahead of that game. Whether you're 50, 30, 40, 20, doesn't matter. You have time, you have guidance, you have a desire to improve, and you cannot be like this 5%. And if you are in your 60s or 70s, well, good for you for trying to learn and build this better so you can teach the next generation how not to do this and be a part of it. So you guys today are going to be the 5% if you implement what we teach. And the biggest difference between you guys and that 95% is your willingness to invest your time and your money to be here today. So let's talk about some 5% stuff. Let's talk about why people aren't successful. And to me, it's simple. There's two things I think get in the way of everything. There are wealth killers and there are mindset issues people have. Wealth killers, meaning taxes, inflation, volatility. When you go out and work hard for your money, a portion gets taken out for taxes, and then whatever's left over after all your spending, whatever you save has to be invested, and it's going to fight inflation and volatility the rest of your life. It's very, very difficult for all those things to happen for you to end up successful. And last, mindset. Guys, America is filled with sheep. We just do what the next person does. We're not leaders. We need to be leaders in our communities. If you're following the status quo, you're not going to become successful. If fear gets involved, you're not going to become successful. Life gets in the way too sometimes. We all had COVID happen to us. That happens. And so that on top of these other wealth killers makes it incredibly impossible to be successful. And so that's why being successful is kind of an anomaly. Everything's against you to be successful. That's why it's so fun to work towards it. It's a challenge. Can you be a part of the 5%? Can you show your kids how to be a part of the 5%? I want to be in that game. Let's figure out a way to do it. Let's find a way to be the top 1%. And it makes me think of this quote by Mr. Will Rogers, where he says, the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. Think about that. It's what people think that they know. We think we know how money works in America. We don't. A lot of us, what we've been taught about money from a young age is not true. So we need to have an open mindset this entire presentation, because when we talk about how money really works, it's going to blow your mind. And I want to start with this little demonstration because I love talking about this. This is something I think everybody learning this strategy needs to start with. It's about learning how to ride a bike backwards. You know, when you get up on a bike, it's muscle memory. You get up, you turn the handlebars left, you go left, turn it right, you go right. Super simple, right? We all do it from a young age. But there was a guy who did an experiment on YouTube, and he said, hey, well, what if I turned the handlebars backwards? Every time I went left, it went right, and vice versa. How would I be able to ride the bike? Would I be able to? He did this experiment. It was really interesting. It took him hours to actually figure out how to ride the bike. He'd get up, take a couple pedals, and fall over. And he did that over and over and over again for hours until he finally got it. Once he got it, he could ride the bike backwards. His mind shifted. And then when he tried to go back to riding a bike the regular way, the way he did for the first 40 years of his life, he couldn't do it. He looked like a toddler not being able to ride his own bike because his mind had shifted to the way the handlebars were, and now he had to shift back. And it was incredibly difficult to do so. But he did learn how to ride the bike backwards. So when you guys learn something one way, it's very hard to change. And that's same for money. It's the true statement for money as well. Since we were little, we've been trained how to think about money. But what would happen if I told you that what you've been taught was wrong? It'd be very difficult for you to change to the new way of thinking. But it wouldn't be impossible, because eventually you would learn how to ride the bike backwards, just like this guy did. And earlier I mentioned to you guys, this is an old strategy. Well, let's talk about who talks about it today. Yes, there's old families and people who did this, but in today's world, Robert Kiyosaki talks all about how he does this strategy of infinite banking. Tony Robbins talks all about it in his book. This book by R. Nelson Nash, Becoming Your Own Banker, discusses this concept in depth. If I were you guys, I'd read every single one of these books. And these last two books are by my good mentor, Chris Naugle. He teaches this strategy as well. All of you today are here because of Chris Naugle, so you should recognize that name. Now, of these books, these are not the only people who talk about this. And there's a lot of other mysteries of money that these people talk about. First of all, they talk about this. What's the definition of money? Straight up, what is money? You guys in the chat, what do you think? Let's bring the chat back up. What is the definition of money, guys? Awesome. 100%. You guys are right. For me, the definition of money is just a means of exchange. That's it. You guys make money, and money is traded for food. Food is traded for money. Money is traded for cars. Cars for money. House for money. Money for house. It's just a means of exchange. That's it. So what about compound interest? You guys heard about compound interest before, right? The eighth wonder of the world. Who uses compound interest? What companies use compound interest? Do you guys know? Those of you who were here last week, you would know the answer. But anybody else who's new here, what companies use compound interest? Well, most people say banks or Wall Street, but the answer is really not one business. None of them do. Banks don't. And banks, what they actually do is they charge you compound interest, but they don't use it themselves. Because, for example, if you had a $20 bill, you went to the bank and you gave it to the teller, what would they do with it? Would they just put it in a box in the back with your name on it so when you came back, they'd give it to you? No, that bill goes immediately into motion. It gets lent out. There isn't a business in the world that uses compound interest, and nor do banks. Banks keep money in motion just like you should, but you've just never been taught how to do that. And what about our dollars? Whoever wins the election today, this is going to be interesting, but are dollars worth more today or in the future? We saw over the past 4 years, they became incredibly less valuable. Hopefully that does not happen for the next 4. Dollars are worth way more today than they will be tomorrow, next year, 10 years from now, 20 years from now. It's always going to be worth more today. And same with taxes. Are taxes going to go up or are they going to go down? I don't care who wins, they're always going to go up. Always. And if they don't go up, they're going to find more crap to tax us on. So wouldn't it make more sense for us to pay tax on the seed of our income, our money today, and not on the harvest later down the road when it's much bigger, when it's worth or the taxes are more? Of course. However, a lot of us don't do that. A lot of you here have probably a 401k or some type of employee-sponsored plan. But what you're actually doing with it is when you put those dollars in the 401k, you're giving up today's dollar in exchange for weaker dollars in the future. You're compounding the tax because the tax is always going to be there. And when you pay the tax on the money someday later, it's going to be a larger amount. You won't pay tax on the seed because if you did pay a tax on the seed, you'd pay the tax on today's dollar and not on future dollars that are going to be growing and be worth more or taxes will be worth more then. And the funny thing is we've been taught that this is good. We've been taught that giving up control is the right thing to do, but we don't really do well. We have been taught to do things with money that we've never ever done with things that money buys. For example, do you guys go to the grocery store, go buy a loaf of bread, come home, run inside, open up the freezer door, throw the loaf of bread in the freezer, and then you just wait 5, 10, 15 years, then come back, open up the freezer, take out the bread, and get ready to eat it? No, it'd be freezer burned. You would never even touch it. And what about a car? What if you went and just bought a brand new car this weekend, drove it home, pumped about it, parked in the driveway, and then waited 5, 10, 20, 30 years, and then came back to the car and decided to drive it? We would never, ever do that. That makes no sense. But that's exactly what we've been taught to do with our money. We've been taught to give up control of our good dollars today for weaker, higher taxed dollars later. And if you want to be good at money, then you need to start changing who's in control of it. So let's talk about retirement accounts for a second. What do you guys know about your retirement account? I can tell you what you know. You probably know nothing. You probably know whether it's in a conservative, moderate, or high risk tolerance. And I bet you know that if the statement went up or down last month, but it's probably it. It's probably it. So to truly build wealth, you need to challenge those old concepts, and we need to understand how money really works. So that's what we're going to dive into today. How does money actually work? Well, we've been taught about interest rates, right? You know about interest. Here's an interesting math question. Here's how money actually works that I think is going to blow your mind. Can you guys make money earning 4% while paying 6%? Think about that. If I was sitting here earning 4% but paying 6% at the same time, am I actually making money? 6 minus 4 is 2, so obviously you're not making money. However, if you look at a real life example, you would be. You 100% can make more money earning 4 than paying 6. Let's use an example of if you buy a car. What if I went to the local bank and I had a fantastic high yield savings account? They're paying me 4%. I'm stoked about it. And the bank offers me 6% on car loans. And, some people would say, oh, you have 25 grand sitting in the bank. Maybe just take it out, buy the car cash. That'd be awesome, right? No interest. You buy it cash. That's the smart way to do things, right? No, the smart way to do it would be to leave your 25 in there earning 4% and get a car loan with the bank at 6%. And I guarantee you'll be left with more afterwards. Now, to most people, that sounds ridiculous, but I'll show you the math behind it. 25 sitting in a bank at 4%, 25 at 6% for 60 months. So you buy a car, 60 months, 5 years, you pay a payment. The payment would be $483 a month. So you pay $483 a month for 60 months. You would pay about 29 grand over that 5-year period. Great, right? Sounds about right. But here's this: your 25 grand savings account at 4% over 60 months would end up valuing at $30,500. How? Well, there's a difference between these interests. The interest on your car you're paying down every single month. It is depreciating. It is lowering. It's simple interest. Whereas your bank account is compounding interest uninterrupted. No one's touching it. It's compounding on itself. And so it's just exceeding it over time. If you were to look at the math over the first 6 months, probably the car would be a more efficient way to do it. But over a 60-month time period of buying a real life car, you'd be making $1,500 off of buying a car, just because you finance the car in a better way. So don't always think interest rates are all that. Don't ever think that this is a one-sided question, interest rate for interest rate. There's a lot more behind the picture than I think you realize. Now, besides this though, what are we here to talk about today? This frames it up perfectly, because this spread right here you're making is really what we're going to do. We're just going to find a more efficient place for this bank to be kept. We're not going to use a high yield savings account, but some other account. And you're going to do this exact same idea on every single purchase you ever have in your life. That's why I said we're not changing any of your expenses, any of your purchases, any of your investments. Nothing's changing in your life when you practice this strategy. Only thing that changes is where your money resides while you do them. Just like in this scenario, you're leaving money in the bank and taking a loan against it. We're going to do the exact same thing on every purchase forever, and we're going to make money off of buying everything. That's how you're going to be the bank. Okay, well, let's talk about what the banks do and how it operates. The money multiplier method we're here to talk about today. Talking about these 3 things: the machine, the marathon, and the millionaire. Okay, the machine, because there's a place your money has to run through to make this work. There is a marathon here, because this is not a get-rich-quick scheme. This is not a solve your life in one day problem. This is a long-term strategy of building wealth. And the millionaire, because that's really just your goal. What's your goal here? Is it being a millionaire, multi-millionaire, business owner, time freedom, time with your family? What do you want? Because that's going to determine how you build this machine and how you run the marathon. Okay. When I think about this, I often ask myself this question: could it be possible that there are more efficient environments to store wealth outside of commercial banks that we're not aware of? Really think about that. This should be yes for all of you. And this is a powerful question, because I want you guys to think about what you're not already thinking about, what you haven't been taught to think about yet. And I hope when it comes to money, you can have kind of a learner mentality throughout your life. But what did the big guys talk about? Guys like Robert Kiyosaki, Tony Robbins, what did they say in their books? They have all kinds of rules, but one big one is save 10% of your income. If you can't save 10% of your income, you're not in a space to do anything financially. Figure that out first. But if you are, like they teach, that's what we're going to try and focus on, is how we can control and save that even better. And most people in America, we don't value savings, I don't think, anymore. I think we used to, but we don't value the retention of our dollars, the control of our dollars. And I think the biggest reason for that is that we've been convinced that these environments to store money, like 401ks or high yield accounts, or even just savings accounts, are efficient places, but they are the most inefficient places you could ever think to store money. And because they don't ever do anything in those accounts, they just sit there, they're volatile, you have no control, you can't use it. We forget about it. We forget about why it's important to save. We don't value savings because those environments we're told to save are just horrible. And so what we're going to talk about today is not just the environment, but how we're using this environment, the vehicle, the machine to store our wealth. And I like to call it our bank. The whole idea is you becoming your own bank, right? So what is your bank you're setting up? What is the machine we're going to use to do everything we're going to discuss today? Well, what are some of the attributes of this? Let's talk about your bank versus a traditional bank. Okay, here you go. I'm going to tell you that your bank you're going to store money is going to be liquid. Just like a traditional savings account or a high yield account, it's liquid. Fantastic. Your bank's liquid. That's a huge bonus, especially for those people looking to control and save their money. It's liquid. Second being interest. Don't we all want to earn interest, right? Well, what if I told you your bank was going to earn 2 to 6% tax-free, compound interest, uninterrupted, whereas most banks Savings accounts are paying 0.07%. That is the average in America currently, and they are taxed. On that little interest you earn, it is taxed. Okay, what else? Well, what if your bank was protected? If you were ever in a lawsuit, judgment, lien, your money was safe. Whereas in a bank account, it is not. And last, stability. Guys, COVID just happened. We all saw banks crumble. What if I told you your bank never crumbled and it survived through the Great Depression, through 2008 and 9, through COVID, your bank was profitable even. Now, this is an efficient place to store money. This is a place you can control, you can count on, you can use as your foundation to finance everything throughout your life. And I get it, because most of us have, chaotic lives. We're busy. So actually, the opportunity we get to put money somewhere that's still liquid, compounding tax-free always, completely safe from the markets, no risk involved, and if you were to take money out of it, it's not going to stop the dollars from compounding. Now, that is something we all should dive much deeper into to really understand this. Wouldn't you agree that this is a much more efficient to store money than really anywhere else? Well, what is your bank? And it might surprise some of you. Those of you who've seen this before, you know what it is. The machine we use to run all of our money through, the machine that is our bank that has those attributes, is none other than a dividend-paying whole life insurance policy with a mutual company. Now, don't leave. I'm not here to sell life insurance. I mean, I guess I kind of am, but this is not a regular old whole life insurance. This is not something you can get from your brother-in-law who sells insurance. This is not something you can get from a local insurance agent. This is very, very specially designed policies. And what the heck does banking have to do with whole life insurance? Well, this is actually what the wealthy do. This is what the elite do. If you don't believe me, I didn't make this strategy up. Again, it's a 200-year-old strategy. Who made this up? People have been doing this for a very long time. Top left is Mr. John Rockefeller. He built this strategy. Top right is Mr. Walt Disney. You all know him, Disneyland. How did he start Disneyland? He started it from taking a loan against his whole life insurance policy. What about these two politicians on the bottom left? You all know them? You all love or hate them? They both include this strategy. When Biden became president 4 years ago, his financial statements came out. And guess what it said? He had 4 whole life insurance policies on his balance sheet. Why would he do that? These two bottom guys on the right, billionaires in our today's society, both of them have billions of dollars in life insurance. So why? And you want to know what's even crazier than all of this? Guess who's the #1 purchaser of whole life insurance in the world? In the world, banks. Interesting. BOLI, you can look this up. It stands for bank-owned life insurance. What you'll find is that banks own more whole life. Not IULs, not term, not VULs, whole life than they own in land and buildings combined. Banks actually are the #1 purchasers in the world. And not that not just that they own a lot, banks are buying more every single year. So we need to ask ourselves, are banks stupid? Or do they know something that I don't know? That's the $1 million question. And look, these 4 banks, well-known banks, between these 4, they own over $60 billion in whole life insurance. Guys, that's stupid. That's a ton of money. And they're not stupid. They know what they're doing. They're smarter than I am, smarter than you are, smarter than we'll ever be. So how can we just mimic what they do? And what else do banks do? Well, if you follow money, you follow banks, I'll show you what they do. If you had 100 grand, you deposit it in your savings account. 100 grand is just an easy number. This could be 10 grand, 5 grand, whatever you want it to be. And that bank account, again, is paying you a super high interest rate, 4% on your savings, and you're pumped. Well, guess what they do when that 100 grand goes in? That is a liability to them. So they are 100% getting rid of it. They are going to lend it out and turn that liability into an asset. And so, for example, let's say they lend it out to somebody who's buying a house. They'll lend that money at 7%. Well, what do you think the seller's going to do when they get the money or the proceeds at closing? Put it back in the bank. Well, then what's the bank going to do again with the money? Well, they'll lend it to somebody else. So let's say your buddy down the street needs a new car. They'll lend it to him at 8%. And then they're going to pay the car dealership who's going to put the money where again? Well, right back in. Then what's the bank going to do? Lend it again to somebody who needs a home remodel loan at 9%, who's going to pay a contractor and put the money back in. And then let's say, you go to Vegas, you throw it all on red and you lose everything. You have a lot of debt now. You got to pay off a debt consolidation loan, pay off the credit cards, and where the credit card company is putting the money again afterwards. right back in. So guys, look at this. Who's in control of all of these transactions? Duh, the banks, right? While you're making 4%, they're making 7. They're making a 3% spread. While you're making 4, they're making 8. They're making a 4% spread there. While you're making 4, they're making 9. They're making a 5% on that one. If you total all of these up, they're making 20% more on your money than you are. So how much more money are they making than you guys? If you're making 4 and they're making 20% more than you, what is that math? 16? 20? No. 4 goes into 25 times. So they're making 500% more than you. Soak that in. Guys, if you go to bauerfinancial.com, you will read that banks make between 400 and 1,300% on the money you leave there. No wonder the banks are rich. No wonder they have the largest buildings in every downtown main part of every city in the country. We're paying for that. They're making so much money off us, guys. So much, 400 to 1,300%, every single bank. On bauerfinancial.com, you can find any bank report and they will show you these stats. So earlier when I told you guys banks are the number 1 purchasers of these policies, the thing I asked you was, are banks stupid or do they know something that you don't know? Guys, they're not stupid. They're smart. They know how to do this. They know how to leverage money. So let's get into some real life example, guys. Let's wrap up this whole thing with some real examples so you understand how the money works, how the numbers work. Those of you who are analytical, time to dive into this. Let's talk about numbers. How do banks do this? Why do they do this? How can we implement this? Well, an easy example is buying a car. And Mary, I love that comment she just mentioned. Guys, look in the chat. Mary said, that's why they have dum-dums at banks. They're calling us dum-dums 1,000%. Chris says that all the time. I love that. Thanks for sharing. So again, this is a very specially designed policy. I'm going to show you how to use a policy to purchase a car and pay yourself back, how you can be the bank on buying a car. Super simple example, but you can incorporate this to any idea of any financing thing you ever need in your life. We'll just stick with a car for the sake of an example. So say I want to buy a truck. I'm going to show you how to get all the money back for every truck, every car you ever buy, drive, and own the rest of your life through this strategy. Here you go. There's some things I want to start with so we're all on the same page. Again, this is a machine we're going to use to run our money through. This policy on the right, do not dive deeper into it. I will explain it in a second. But this is just the machine our money runs through. Okay, we need to change our mindsets. When people think about life insurance, they think of it as a payment, a bill, a premium, just like any other insurance. But listen, this is not a payment. In our world, in a policy built like this, we look at it as a deposit. Because who doesn't want to deposit more money in their bank? And why do you deposit money in a bank? Because it's liquid and it's your asset. Well, so is the policy. If it's still liquid, then why not deposit everything you can into it? So I treat this policy as a deposit, not as a payment. And next being age. A lot of people say, I'm in my 50s, my 60s. I can't get a policy. I'm too old. No, you're not. Most people we work with are in their 50s and 60s. So get over it. Age does not matter. We are telling the insurance companies how to structure these policies. If you're older, well, you're probably going to have a much lower death benefit than someone who's younger. That's just the truth, because cost of insurance is more expensive. But that does not mean you can't be the bank. That does not mean you don't have liquidity. That doesn't mean you don't earn interest. Age does not matter. And the death benefit, we're not going to talk much about. We know it's on life insurance. We know death benefits are there, but I'm not building these policies for you to have a death benefit. I'm building it for banking. And so this really, in my opinion, does not matter too much, but it's something to take into account here. So what is the machine? How are we going to use it to buy a car? Here we go. All right. You see this. Deposits 10 grand a year. So really quickly, your premium on this policy is 10 grand a year. This is one simple example. This premium could be $1,000, $100,000, $1 million. This deposit amount can be whatever is desired of you. 10 grand a year is just an easy number. So let's say they deposited 10 grand a year into a policy. The cash value over on the far right is showing the amount of money available to access in the policy. And your deposits in the policy are staying with the insurance company, and they're going to sit there, earn interest, and pay for the death benefit. Where the insurance company now is going to say, hey, if you want to leave your money here, we'll let you get access to it via this cash value. This cash value will be a loan against your policy, and it will be a loan coming from the insurance company's general fund. So that money is coming from the insurance company, and that insurance company is going to lend that money to you using the policy as collateral. And so in this scenario, in year number 1, the cash value was $6,000. Year 2, it was 12 grand. Year 3, it was 4. It dropped because I'm going to show you how to buy a car. So he takes 25 grand out of the cash value in the 3rd year and goes to buy a car. So 25 comes out, still has 4 left over. But if he's going to take a loan from himself to go purchase a car, what should he do? Well, pay himself back as if he'd pay anybody else. If he's going to pay the bank every single month for 60 months, he should pay himself the same. And that payment was about $500 a month. So let's say he does that. Let's say he takes a $25,000 loan against his policy, buys a car cash, and pays himself back $500 a month. He's essentially financing this car through his own system. So over that 7-year period, he pays $70K in deposits, dumping that into the policy as premium. He pays 30 grand back into the policy to repay the policy loans. So he deposited 100 grand into this policy over 7 years. Now what? 100 grand goes in. He took out 25 to buy the car. So his net injection into the policy is 75. He puts in 75 over the 7 years. And look at his cash value at year 7, 67,881. So he puts in 75. He has access to 91 cents on the dollar. He has access to 91% of what he's putting into it. He got 91 cents back on every dollar he put into buying the car, you could also say. Okay, now let's take a second here. What if he wanted to buy a car again? Let's say in the 8th year. Takes another loan from his policy to buy another car. Let's also say he doesn't want to pay any more premiums. After 7 years, you are able to stop paying premiums on the policy if you like, most policies. And so he does that. No more premiums. And he still has the policy, still has the cash value. And he takes a loan for 25 to go buy it. Well, he's going to pay himself back $500 a month again, right? If he's going to take a loan from himself, he should pay himself back. So he deposits 30K into the policy over that 5-year period. He also takes out 25 to buy the car. So he put in 5 over that 5-year period. He essentially put in 5 grand. 30 minus 25 is 5. So he injects 5 grand into the policy. And look at his cash value growth over that time period. It grows from 67,000 to 91. Your cash value grows by $23,000 and you put in 5. So you made money off of buying a car. Keep soaking this in. He took out, or he put in 5 and he grew by 23. He made, what is that? 18 grand on buying a car. If you also look at the cumulative amount, hey, in year 1 to 7, he put in 75. Year 8 to 12, he put in 5. So he put $80,000 into the policy over that period. And he also bought 2 cars. They're sitting in his driveway, fully paid off. And he still has $91,000 in the cash value left over to use afterwards. He got all the money back for both the cars and made money off of buying 2 cars. And he did that because his premium dollars he paid in are always earning interest, always compounding tax-free. He has the death benefit. His money is completely protected. And he just took a loan against it, bought the car, and paid himself back. Now he's earning money while buying the car. He could have spent the 25 grand cash and bought the car cash, but then remember, now it's gone. He lost 25 grand. He no longer can earn interest on that 25 grand. But if he took a loan against an asset earning interest, compounding on itself, he will always end up with more on the other side. Is this making sense, guys? Do you want me to go deeper over this? Any questions about this? If not, I'm going to show you another example of paying off debt instead of buying something. But does this make sense, guys? We're going to go through a couple more examples before we hit all your questions. So maybe start thinking of your questions, start writing them down. So here's 3 rules we have to do and use if we're going to do this. Rule number 1, pay yourself first. Instead of saving 10 grand a year, or instead of putting 10 grand a year in an IRA, he's paying himself first. He's paying that 10 grand a year to himself, putting it somewhere he controls. You need to understand that rule first. Rule 2 is he paid himself back with interest. He paid himself back more than the 25 he took out because he's going to be an honest banker with himself. If he would pay anybody else more, he should pay himself more. And rule 3 is he's going to recycle and recapture that money, because who doesn't want to pay the interest back to yourself instead of other people? He's recapturing the interest he otherwise would have paid somebody else. That's pretty freaking cool. So if you can do this for a car, what else can you do this for? Everything. I'm going to show you debt next, but everything.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, It's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So debt, let's show you a couple examples. Yes, Gary, your business could write off the interest if you had your business lending money or something, yes. So let's say you have some debt. This is a chiropractor we worked with. He had all kinds of debt. He had 9 third-party debts, paying over $5,700 a month, and it was a total of $478,000, including his house and a condo he had. Now, you guys could be in a very different situation with maybe 1 or 2 credit cards, or 1 mortgage, or 10 loans, or more or less. But this is just a scenario. He was going to take 19 years to pay off all his debt. That is a whole lot of time. Okay. And he already paid off his student loans. Imagine including that in this too. So he does not have that anymore, or student loans anymore. He just has these loans here. And he's going to say, hey, well, you know, he came to us and said, hey, I save about $2,000 a month. I put it aside in my savings account, but I know I can use this savings more efficiently. And we said, yes, you can. Let's run your savings into a policy and then use the policy to pay down your debt. So that's what we did. We put in $25,000 a year into the policy. So year number 1, he put in 25. His cash value that he had available was about 14, 15 grand. So he takes that $14,000, $15,000 loan against his policy and pays off the first 2 and the third a little bit. Now, what's he going to do? He took a loan from himself, so he needs to pay himself back. How is he going to pay himself back if 25 grand a year was all he could save? Well, look at those 2 debts he just paid off. 161 a month was the payment for the Discover card, and 287 a month was the payment for the Lowe's card. Well, now that is new income he can now save. So now he's going to pay himself back those 2 payments. It's going to be $448 a month he's paying himself, and $5,300 now he's only paying to other people. So every month now he's paying himself back a little bit more. So year 2 rolls around, he dumps in 25 again, takes out 16 now, he has access to 16, and he also paid himself back every single month, $448 a month. So now he paid himself back $5,000 throughout the year. So now he has a total of the cash value and his repayments. So he's about 22 grand available in this year number 2. Pays off the next 3 loans and some of the car, which frees up all those payments, which he can then use to pay himself back. So now he's paying $3,800 a month on his debts, and $1,900 a month he's paying back himself. Let's keep going. Year number 3, he dumps in 25. He has access to 25 because remember his compound or his deposits are compounding interest, so he has access to more and more every year. He also paid himself back $1,900 a month. So now he has 48 grand this year to use, which he uses to pay everything else off except the 2 bigger loans. Guys, in just 3 years, he's almost debt-free, and he's saving now a new $3,600 a month, and he's only paying $2,100 a month on his debt. He could stop here if he wanted to. He's saving a lot more, way more efficient with his finances now, just 3 years in, not 19. But let's go a step further and pay off these houses too. So what's happened over the past 3 years? How much did we put in? Well, 25 each year. Those were the premiums. He also took out loans against this policy. Year number 1, he took out 14. Year 2, he took out 16. And year 3, he took out 25. So he took out 25 throughout those 3 years. So question for you guys, how much is left over in the policy after these 3 years? Put in 75, took out 55. Some would say 20. Well, the whole 75 is actually still inside the policy, still earning interest, still growing for you. Remember that we're not we're not borrowing or withdrawing the money we put into it, but instead we're putting that money up as collateral and we're taking a loan against it using the insurance company. Okay, so we still have the whole 75 sitting inside the policy earning interest. Now from here, what? Well, in year number 4, he deposits another 25. He has cash value, he has repayments, he has a bunch of cash, he pays down the condo, chunks it down. 1 more year goes by, he does the same thing again, chunks down the condo, house, all that's left is that. So now after 5 years, he's paying himself back $4,500 a month, and he's only paying $1,200 a month for his house payment. That is it after 5 years. Well, after 5 years, the insurance company came to us and said, hey, he can no longer put in 25 grand a year. He actually only can do 10 grand a year from here on out. He's put in so much at this point. He's almost breaking the rules the IRS has set in here. So we need to lower it. So they lowered the premium to 10 grand a year. Great. He also came to us and said, hey, my business is doing a lot better now. So I can do another premium. I can do another 2 grand a month. So now he has 2 policies. He dumps in 10 in the first, 25 in the second. So he has cash value on both policies available. He repaid himself every month. So you had all that cash available and pays off the house. So in year number 6, he is now debt free. So what if you don't have bad debt? What if you don't need a new car? Can you still benefit from being your own bank? Should I still want to become my own banker? This is the question for you guys. Well, those of you on here, if you guys are looking to do this, that's what we're going to discuss. That's what we're going to try and figure out a way to do. And so I'm not here to sell anything, but merely share this knowledge. And if you guys do want to hop on a call with me later and talk about how you can implement this, we definitely can do so and show you how you can implement this strategy for you to become your own bank. But after all this stuff is done, it just gets fun. I don't have any debt. I don't have a new car I need to buy. I'm in real estate. I'm buying rental properties, flipping houses, and so I can now do all of that, building my wealth side of things through my policy, which makes it way more fun. I'm really creating a legacy now. And I just skipped over those real quickly because I want to show you this. What if I chose to pay my policy back every single month, the original condo and house payments, just like I was going to pay them? Well, I still had 251 months left on my condo and 224 left on the house. That would have been a total of about 500 grand. I was gonna keep paying on all those payments to pay off the condo and house if I was to keep paying on them. But because I paid it off early and I paid myself back, I'm now recapturing almost $500,000 by repaying myself 500 instead of paying the bank that 500 over the next 250 months. So guys, it's not just that we're paying off our debt faster, it is recapturing all the money we would have paid to somebody else. Now that you know this, now that you know this is possible, you know that everybody is doing this, how can you do this? How can you not do this? I would strongly recommend if you're in a position where you save money, this is for you. If you don't do this, you are stealing from your kids and your grandkids. You're stealing from the next generation. That's really what's happening. Because it doesn't matter what you make. You can make $10 an hour or $10,000 an hour. It doesn't matter. This works for anybody. And think about it. Why do the wealthy people do this? Why do the banks do this? It's because they understand how to keep money in their family. So we need to break the financial slavery we've been told to be a part of in America. For us to not be a part of that 95%, we need to change the direction we're taking. And this is the way to do so. When you do this, you're not just setting yourself up, but we're taking care of those around us. So guys, infinite banking is about control, controlling your money. It's also about getting that money working for you so you can stop working so hard for your money. So as we wrap up here, let's talk about other aspects of infinite banking that we haven't covered yet. Let's skip this. We kind of already hit this. Policies are safe. You can use policies for tax-free income for retirement. You could get policies on your kids, pay for college, start businesses. You can do anything you want through a policy. Now, how do you fund a policy? What should the premium be for you? Well, you can fund it at whatever frequency you want. Monthly, quarterly, annually, large lump sums. The minimum I'd recommend is at least 10 times your age a month. If you're 50 years old, you should be putting at least $500 a month into a policy. And we came up with this formula because if you are not able to save money, you're not in a position to do this. And this is a minimum you should be able to save. If you can't save, go work on that first. The second would be the maximum. How much is the max you can do? Well, it depends on people. We've put millions of dollars into these policies, but it depends on your net worth and your assets. On top of a premium deposit, you can do a very large lump sum to start a policy. If you had $500 a month, you wanted to start saving and running through a policy to then finance things in the future for yourself. And let's say you also had 20 grand sitting in a bank. Well, you could dump the 20 grand into the policy up front and do $500 a month. You can move all your extra income into the policy and you will have access to 60 to 90% of that total premium in the first 30 days. Right away, you can access this money. You don't have to wait 10 years to access your policy. You can access it day one. That's how we're specially designing these policies for banking. And policy loans, cash value availability, all the same terms, so don't be confused. I look at policy loans as like just a outstanding line of credit. Just like how a line of credit operates, if you take out a line of credit, you owe interest on that, simple interest for however many days you have that loan out for, however many months. You choose how you pay it back. If you pay it back, everything you pay back is still liquid and available for you. It's just a line of credit. Kind of how the policy operates as well. The policy loans are also guaranteed. You can take a loan whenever you want. The insurance company can't stop you from taking a loan. And there's no credit checks or approval needed. You ask for the loan, they send you the money. That is it. You don't have to get approved to get a loan. Also, these loans are private. They don't even go on your credit report. They're safe. And there's no minimum or maximums on your repayments. When you repay the policy, you're in control of how you do it. And if you miss the payment, nothing happens because you're taking a loan from yourself. So who cares how it's paid back? You should choose how to pay it back. You choose the payment plan, the structure, and if you miss paying it back for a certain month, great, that's fine. So now you have a lot more flexibility to pay your debt off how you want. So why us? Why the money multiplier? Well, because we specialize in banking. We teach banking specifically. We have and met with over 20,000 families across the country between our whole team teaching this strategy. We do this strategy. I'm in real estate. I implement this strategy every single month in my real estate deals. So we're not just here talking about this, but we're doing it. And as well, I should hit this really quickly. A lot of people come to us and say, oh, could I use an index universal life policy? I've heard a lot about those. Could I do premium financing? Can I use universal life to do this? No, is the short answer. We can discuss that maybe during the Q&A further, but the answer is no. You have to use whole life to do policies like this, and very specially designed whole life. So really, guys, to end off here, only one of two things are going to happen to us throughout our entire life. And what are those two things? Well, we're either going to live or we're going to die. And I just showed you you're way better off with this while you're alive. You can pay off debt faster, multiply money in investments. You can grow your wealth while you're alive. And two, well, what if you passed away? Well, if you passed away, your family gets nothing. They just get what's sitting in your account. But if there's a death benefit attached to this policy, they're going to get a huge lump sum. So your family is way better off with this than without as well. And Warren Buffett said it best. He said, if poor people would just do what rich people would do, they would not be poor anymore. Guys, he's 100% right. And guess what Berkshire Hathaway owns? Warren Buffett owns this company, smartest investors of all time. He owns Berkshire Hathaway, which owns an insurance company. Why would he want to own the insurance company? Why would he want to be in the insurance business? Guys, insurance is boring. It is not talked about. It is not attractive, but it is the foundation and backbone of people building wealth. And not term insurance. Term insurance does not do that. It is specially designed whole life. So for you guys to take back control of your financial future, let's hop on a call. This is my personal calendar. I will have a free consultation for you. And we teach this stuff for free. We get paid from insurance companies. We don't charge you for setting up policies. We don't charge you for teaching you how to pay off debt. We don't charge you for how to buy real estate. We don't charge you how to use your policy to be your own bank. Nothing. It's all free. We are here to just teach you how we do this, and we'll help you set up the right system to do it, and then you guys can go out there and do it. This is a system for you to take control over your money, not for me to manage it for you. I don't want to touch your money. I want you guys to do this and build your own system for your family yourselves. So this QR code, it might not work anymore, so maybe even don't even bother looking that up. Go to that website, carson.beyourownbanker.com. That is my personal calendar. You can hop on there and meet with me individually and talk about your scenario, and we can discuss if this makes sense for you, how it should be set up, and what you should be doing. And I met with even a few of you who are on here today. So if you guys who are on here today who already know me, we have a policy in the running for you guys. Let me know if you have more questions about this. Let me know if you want to make sure your system's set up in a certain way. But I just threw in the chat here my personal email. If you guys are just like, hey, this is my first time being here, I just want to learn something more. I want to get, more due diligence figured out for myself. Email me. There's my email, carson@chrisnaugle.com. I will send you any videos you want, any books, any PDFs, a podcast. I have all kinds of resources I can send you for you to better understand this strategy. Now, that link at carson.beyourownbanker.com sends you guys to my personal calendar. So if you'd like to meet there, you can do so. And last, I want to know about your guys' journeys, your guys' lives. I want you guys to know about mine. I want to keep sharing and growing with you guys. So follow me on social medias as well. Carson Herlean, you'll find me anywhere. I'd love to understand what you guys are doing with your lives, how this could help you and see your families. Follow me too. So we're going to end here with question and answers, some Q&A. I got the next 15 minutes for you guys to do whatever Q&A you guys want. Hit me. Let's just get going with it. Let me know your thoughts or questions. Even if you just have some comments to make on this, I'll give you 30 seconds to write down your questions and I'll get to them. Carson.beyourownbanker.com. I just threw again in the chat. There are some Q&As from Vince. He asked questions throughout this whole thing, so thank you. I can get to his unless nobody has any other questions. So Mary said, does credit score matter? No, the insurance companies doesn't care your credit score. I mean, there's a little bit of, they kind of do. If you have a 300 credit score, that shows you're extremely financially unresponsible. They're probably not going to give you a policy. But I've never seen that happen. I've never seen credit be an issue. Credit score does not matter. Mary said, how much does cost? What is the cost to get started? There is no cost. I think I just said it. There's no cost. There's no fees. You don't pay us anything. There's no cost to do this. You're just setting up an insurance policy and you're funding it how you'd like. You're using it how you'd like. You're just taking control of where you store and save your money. Instead of saving money in other places, you're now saving it in a policy. So it's you changing and redirecting where all your money is kept. That's what you're doing. There's no cost to do that. So Vince asked a few good questions. He said, what's the cost of taking a loan from the policy? Well, insurance companies charge interest on your loans. It's a simple line of credit, essentially. And most insurance companies are charging 4 to 5% right now. So there's that. I know written into your insurance policy contract, banks or insurance companies can't charge you more than 8% ever. So that's locked in. And the interest all goes to the insurance company. 100% of it does. You're taking a loan. So yeah, all of it goes to the insurance company. What's the process of taking a loan? Well, you'd fill out a document online, you'd send it in, and they'd send you the loan amount via wire or ACH within like a day or two. So it's very easy. Is the different type of risk we take on via these policies purely legislative? Like the risk is that the MEC limits change and we're left with policies that just aren't as advantageous. The MEC limit doesn't matter. The policy is advantageous no matter what the MEC limit is. I mean, the policy is just a safe place to store money. So I don't really understand your question. There's no risk. I mean, the policy itself is a guaranteed contract with an insurance company that the insurance companies can never waver from. It has to happen. So it's a guaranteed contract you have. There's no risk in that. So I don't know what your question really is. I mean, the risk in all of this strategy is you not using the money right. You taking loans and making dumb investments, you spending the money on vacations and not assets. I mean, that will hurt you, of course, but that's going to hurt you no matter what you do. So there's no risk in this whole scenario, really. Are there good tools for managing this? Yep, we can wrap up here. We'll wrap up in one more minute. Patel, how much of your premium capital is going to broker fees and mortality charges? It depends on your age, your health, your income, how much premium we're doing, how much we're dumping in up front, what we're trying to solve. A lot of issues or a lot of factors involved there. So that'd be more so a question we discuss on a one-on-one conversation. But if you have access to 60 to 90% of your premium right away, well, then there's not much cost at all. And most of these policies, you have access to 100% of your funds within the next 2-3 years. So, I mean, very little cost. That's why the death benefit is so low on these policies as well. We're building these policies to have more cash value and less of a death benefit. That's the whole point of this. All right, guys, we got to hop off here. So you have the recording. It'll pop up on Chris's YouTube later today. You have my email and my calendar link if you'd love to talk further about this. But you will see us here every week talking about this. So thank you for being here. We'll talk to you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.